Why do so many crypto projects seem to burn incredibly bright for a moment and then, poof, just vanish, taking a whole lot of investor money right along with them? It's a huge issue, and it's plaguing the entire industry. So what's really at the heart of this trust problem, and more importantly, is there anything we can actually do to fix it? Let's dig in. Here's how we're going to break it down. First, we'll get into the absolutely shocking scale of crypto's collapse problem. Then, we'll uncover the accountability vacuum that lets it all happen. After that, we'll explore a pretty interesting idea for self-regulation, look at the big choice the industry is facing right now, and wrap up by talking about that crucial balance between innovation and accountability. Okay, so first things first. Just how bad is this collapse problem we're talking about? Well, to be perfectly honest, the numbers are absolutely staggering. Let's start with a real gut punch of a statistic. Think back to the crazy hype of the 2021 bull market. New tokens were launching left and right. Well, according to research from CoinGecko, a jaw-dropping 95% of those tokens have since crashed by more than 90%. That's not just a dip. That's a near total wipeout for almost everyone who jumped in. And if you're thinking, oh, that was just a crazy bubble, think again. This isn't old news. In just the first quarter of 2024, get this, over 1.8 million new tokens collapsed. This isn't just a few bad apples. It's a systemic problem that's happening right now, and it's seriously damaging trust in the whole space. And here's the really tough part to swallow. A lot of this isn't happening by accident. The source material for this explainer argues that many of these projects aren't failing in the way a normal business fails. No, they were never built to last. They were designed from day one to create a frenzy, attract a flood of cash, and let the founders cash out, using regular investors as their exit liquidity. So that brings us to the core of the issue. Why does this cycle of hype, pump, and dump happen over and over again? Well, it really comes down to a fundamental gap, something traditional financial markets have that crypto is seriously missing. It's a concept called fiduciary duty. So what is fiduciary duty? In traditional finance, it's a legal requirement. It's a law that says the executives running a company are obligated to act in the best financial interest of their investors, the shareholders. It's a bedrock principle that forces them to be accountable. And this is where the two worlds really split. In the stock market, if you neglect your shareholders, there are serious legal consequences. But in the crypto world, there's just no equivalent standard. Founders can raise millions of dollars with some flashy promises and then face almost zero pressure to actually deliver on their roadmap or manage that money responsibly. This lack of accountability is the fuel for the fire we were just talking about. It creates this environment where all you need is a slick website and a few buzzwords to get people to invest, but there's no system in place to make sure those teams actually work towards building something that lasts. Okay, so things sound pretty grim. But what if the industry doesn't wait for governments to step in? What if it could fix this itself? The source we're looking at proposes a really proactive solution, building a system of trust from the inside out. So the big idea is this: create voluntary third-party rating organizations for crypto projects. Just think of how Moody's or S&P give ratings to companies in the stock market. It's the same idea. These agencies wouldn't have legal power, but their ratings would give investors a clear signal, helping them tell the difference between a legitimate project and a potential rug pull. So, how would a system like this actually work? Well, it would be built on 4 key pillars. First, a tokenomics review. This means digging into the token's design itself. Is it built to be sustainable, or is it just designed to inflate and then crash? Second, vesting discipline. This one's huge. It scores when founders and early investors are allowed to sell their tokens. A good score means there are rules to prevent insiders from just dumping everything on the market at once. Third, a transparent liquidity strategy. This would require teams to be upfront about their plans for getting listed on exchanges so you don't get stuck with a token you can't even sell. And finally, a founder trust score. This is really cool. It would basically be like a credit score for the people running the project, tracking their history and whether they actually deliver on what they promise. All of this brings the entire crypto space to a massive decision point, a real fork in the road. The industry can either keep going down the same rocky path, or it can choose to build a more accountable, trustworthy future. The stakes, well, they couldn't be higher. So let's ask the question head on. What are the real consequences of doing nothing? If the industry just lets things continue as they are, what does that future actually look like? This slide really lays out the two futures pretty clearly. You've got path A, self-regulation. The industry gets its act together, builds that trust, protects investors, and you know what? That could finally unlock the floodgates of institutional money that's been waiting on the sidelines. But then there's path B, inaction. The bad behavior just keeps going, and that almost guarantees that governments will eventually step in with heavy-handed rules that could end up stifling the very innovation that makes crypto so exciting in the first place. And this really brings us to our final crucial point. This isn't a choice between innovation or accountability. It's about finally understanding that in the long run, one simply cannot survive without the other.
Ultimately, it all comes down to this. If cryptocurrency is ever going to evolve beyond being a high-risk speculative playground and become a respected, lasting part of the global financial system, it has to grow up. It has to voluntarily embrace the kind of accountability that underpins every other mature market out there. And the source material puts it perfectly. Decentralization cannot mean lawlessness, and innovation without accountability is a dead end. The question now is whether the industry will build the guardrails it needs to ensure its own survival and success, or just wait for someone else to build them instead.